Today, proceed with caution. The DFA daily to the 14th of September 2021. Finance Analytics, welcome to this post covering inflation expectations. For tax hikes has favoured value. There are probably not a lot of positive surprises coming this month, said Liz Young, head of investment strategy at Sophie in New York. We're having another period of volatility where I think that rotation could go back to cyclicals and the reopened trade as the 10-year bond rate slowly grinds higher through to the end of the year. Market participants are focused on the likely passage of US President Joe Biden's $3.5 trillion budget package, which is expected to include a proposed corporate tax rate hike to 26.5% from 21%. Goldman Sachs analysts see the corporate tax rate increasing to 25% and the passage of about half of the proposed increase to tax rates on foreign income, which they estimate would reduce the S&P 500 earnings by around 5% in 2022. And the Labour Department is due to release its Consumer Price Index data on Tuesday in the US, which could shed further light on the current inflation wave and whether it's transitory, as the Fed insists. I don't see inflation settling back down below 2%, where it was pre-pandemic, Young said. Even if some of those transitory forces weaken, we will stay at a higher rate than we were before. And in fact, inflation expectations among US consumers over the medium term rose to the highest level on record in the Federal Reserve Bank of New York's surveys, which was released on Monday. The August 21 survey of consumer expectations shows that short and medium-term inflation expectations rose to a new series high of 5.2% and 4% respectively. Home price growth expectations continue to moderate in August but remain elevated, and households' perceptions about their current financial situations did improve, and income growth expectations also rose to a new series high. Consumers said they expect inflation of 4% over the next 3 years, up 0.3 percentage points from a month earlier. And the median expectation for the inflation rate in a year's time also rose by 0.3 percentage points to 5.2% in August. That's the 10th consecutive monthly increase and a new high in the series, which goes right back to 2013. The Fed survey shows that Americans are expecting higher rates of price increases for items like rent and food that make up a large chunk of the consumer price basket, and those can't easily be substituted. Meanwhile, expectations that wages will keep pace with the acceleration in prices are starting to cool. The median 1 year ahead expectation for earnings growth dropped 0.4 percentage points to 2.5%, with respondents over the age of 40 largely driving the decline. But overall expectations for household incomes rose by 0.1 percentage points to 3%, which is a new series high. Other key indicators due out this week include retail sales and consumer sentiment, when that could illuminate how much the demand boom driven by economic re-engagement has been dampened by the highly contagious COVID-19 Delta variant. The Dow Jones Industrial Average rose 26.1 points, or 0.76%, to 34,869, and the S&P 500 gained 0.23% to 4,468, while the Nasdaq Composite dropped 0.07% to 15,105. Of all the major sectors in the S&P 500, healthcare suffered the largest percentage loss, while energy, buoyed by rising crude prices, was the biggest gainer. Shares of vaccine makers Moderna and Pfizer sank 6.6% and 2.2% respectively after experts said that COVID booster shots were not widely needed. And Coinbase Global announced plans to raise about $1.5 billion through a debt offering aimed at funding product development and potential acquisitions. The cryptocurrency exchange's shares slid 2.2%. The volatility index was down 7.54% to 1937. Gold futures for December delivery was up 0.14% to 1,794, and crude oil for delivery in October rose 1.35% to $70.66 a barrel. The euro-US dollar was down 0.04% to 1.1810, and the US dollar index was up 0.04% to 92.61. Now, over in New Zealand, the latest data for August from REINZ revealed that the number of homes sold was down 26.5% and median prices fell in 6 regions, with 5,753 residential properties sold in August this year compared to 7,828 in August last year. Given the tightening in lending and talk of rate rises, the decline in sales perhaps was not unexpected when coupled with the country moving to level 4 lockdown during the second half of the month, although Auckland appears to have weathered the storm better than the rest of the country. In fact, the data shows that in Auckland, sales numbers in August were down just 12.8% compared to August last year, while the rest of the country, excluding Auckland sales, were down 33.7% compared to a year ago. The national median selling price hit a new record of $850,000 in August, giving an annual growth rate of 25.5%. Although most regions recorded ongoing growth in median prices in August, it was significant that median prices in 6 regions recorded declines between July and August. Some of those price falls were substantial, such as Northland, where the median price declined from $660,000 in July to $580,000 in August, and Gisborne, where it declined from $625,000 in July to $500,000 in August. Other regions where the median price declined in August compared to July were Hawke's Bay, down $25,000, Nelson Marlborough, down $29,900, Otago, down $5,000, and Southland, down $15,000. Within the Otago region, median prices in Queensland Lakes declined from $1,170,000 in July to $1,045,000 in August, while Dunedin's median price declined from $651,000 to $629,000 over the same period. So the question now, of course, is whether this is a blip. It is the time of year that people start to prepare their property for the usual increase in spring sales activity, and it's expected that this will be stronger this year as listing is delayed due to the lockdown, REINZ Chief Executive Jen Baird said. We understand that vendors have been preparing their properties for market to list them once we reach a lower alert level. We expect to see the result of this in our September data, she said. Clearly, property spruiking remains as much a sport across the ditch as here. Now, in Australia, the ACCC chair Rod Sims has said it is not in the interest of the Big Four banks or their shared owners to fire up rivalry between them. Appearing before the House of Representatives Standing Committee on Economics on Friday, the 10th of September, he reflected on the question of common ownership across Australian industries. He noted in most Australian sectors there were only a few major competitors, pointing out 4 in the case of banking. When you get well-established companies, 2, 3 or 4, often they're not competing vigorously with each other for one reason or another, he said. Then, when you get concentration in wealth management, you could find that common ownership of a small number of competitors. Shared owners could be the result of index funds or large fund managers grabbing stock in each major company within a certain industry. But Mr. Sims commented problems could arise with the same investors speaking to management and to CEOs across different companies. We know they do that. If they've got a common interest in the small number of competitors, they might be seeking to send messages about industry profitability rather than the particular company, which might soften competition between competitors, he said. MPs on the committee had already raised alarms around the major banks sharing the same dominant institutional shareholders in its inquiry into the implications of common ownership and capital concentration. NAB Chief Executive Ross McEwen, Westpac boss Peter King, and representatives from APRA and ASIC also faced questions around the bank's ownership last week. Mr. Sims acknowledged that 2 largest shareholders are consistent across the Big Four banks, with US fund manager giants Vanguard and BlackRock holding around 5 to 6% in each of the institutions. However, he questioned whether the major banks were more likely to be swayed by investors to resist competition if they already had an agenda to soften any rivalry themselves. How much influence that has versus just simply their obvious commercial strategy of not bothering to aggressively compete with each other, and that's where it gets complicated. To know what's driving what, Mr. Sims said. But my instinct with the banks is it's not so much common ownership, it's just their well-honed strategy and realising that active competition against each other is just going to lead to retaliation or not help you at all. And going off his past commercial experience, Mr. Sims said it was unlikely that the banks would need to be prodded by an investor to act accommodatively towards each other, as they had operated side by side for a long time. Having said that, the fact that those people are meeting the CEOs of each of the banks with a common message is obviously an issue, he said. ACCC specialist for advice and services Marcus Beasy referred to a remark from the OECD roundtable by researcher Mark Schmaltz, stating that common owners may not encourage firms to compete as they have no incentive to intervene in firms' competitive strategies. However, there's no evidence that common owners push for more aggressive competition, he said. I think that's a really interesting point. They're not going to really require firms across an industry to compete more aggressively. It's just not in their competitive interests. That's probably the heart of our concern. The result could quash both competition and innovation, Liberal MP Celia Hammond responded. And finally, on Friday the 3rd of September, it looked like the two leading cryptocurrencies that hold about 60% of the assets class, market cap Bitcoin and Ethereum, were heading for new record highs. Ethereum rose to over $4,000, and during the long Labor Day weekend that followed, Bitcoin soared to near $53,000 per token. Bitcoin's record peak occurred back in April the 14th, 2021. That was the day of the Coinbase global IPO on the Nasdaq, and then the leading crypto reached $65,520 in the futures market and nearly $64,800 in the over-the-counter market. Ethereum's high came on May the 12th, when the over-the-counter value reached just over $4,370, and nearby futures traded to a peak of $4,406 per token. The most recent rallies in the top cryptos ran out of upside steam on September the 7th, when El Salvador officially adopted Bitcoin as its national currency. Bitcoin and Ethereum drew chart points as they made lower highs. Now, the bulls view the price action as another opportunity to load up on the cryptocurrencies, while those who believe they have no intrinsic value would say, "We told you this would occur." The volatility in the asset class is unprecedented, creating lots of trading opportunities. However, the potential rewards come with lots of risk in an asset class where extraordinary price variance is the norm, not the exception. Crypto's moved from bullish to bearish trends over the past week in the asset class, where sentiment can be as fickle as the weather. The bulls undoubtedly believe the most recent price correction in Bitcoin and Ethereum and a host of other cryptos is another buying opportunity on the road to even higher prices. Opponents are waving a warning finger, saying that the price action is a sign of instability on the road to obscurity. Bulls and bears make for an active and liquid market, so the opponents and proponents would likely fuel a continuation of active trading and volatility. Price variance creates a paradise for traders, but can be a nightmare for investors. It's worth making the point that the crypto asset class remains in its infancy. The short-term picture is probably one of lower highs since the April and May peaks, but beyond that, who knows? And I've said before, it becomes more a matter of religion rather than anything else, because there's no way you can analyse what may happen. If enough people believe, well, prices may go higher. But as I discussed with Adam Stokes the other week, there are lots of things going on below the waterline which could fundamentally change the future dynamics of these markets, not least large, well-capitalised players who are trading the volatility and taking positions to maximize returns without any long-term interest in holding the cryptos. That is a further reason why volatility will continue. And in fact, of all those points today, I think the ACCC point is the one that's most interesting because it underscores one critical thing that we need to understand. In Australia, and probably elsewhere too, banks do not compete heavily with each other, despite what they may say. They're all playing the same game, they're all funded the same way, they all have the same interests in milking consumers and small businesses. And whilst the regulators may try to encourage them to compete more strongly, the fact of the matter is we pay over the odds for our banking services in Australia because competition is just not strong enough. Now, that may be surprising to some, but if you look at the margins on our banks here relative to others around the world, they are doing pretty well at the moment, and that's because we pay more than we should. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.